Perfect. So we are saying that we have our KAZINDA. This is a practice question on VAT. We have KAZINDA, a businessman in Kampala. During the month of March 2025, he made the following transactions. He made sales, general merchandise of 35 million, sold fish, Seka Market, 40 million, from his farm in Kalaji, 50 cows, 1 million, sold general merchandise to Muko Investments, 150 million, exported fish to Rwanda worth 300 million during the month. Other transactions, imported goods from Japan, CIF value 55 million, paid 25% import duty, excise duty 10%. Transportation of goods from Mombasa to Kampala, 10 million. Local purchases, 70 million. Paid salaries and wages, 15 million. Repairs and maintenance for the saloon car, 5 million. Telephone bill, 1.2 million. Medical bill, 2.5 million. Office stationery, 1.3. He returned to his suppliers local purchases amounting to 7.5 million. During the previous 2 years, he had accounted for input tax on a sale of 25 million, but the debt has since gone bad and there is no hope of recovery. Okay. This figure is VAT inclusive. He paid for water and electricity charges amounting to, for the month of February, February, this is 2025. Yes, 2025, for 450 million. For the month of March 2025, if 500, this is 450,000. For the month of March 2025, the water and electricity bill was 550. He also paid in advance for power consumed in April 2025, amounting to 650 million. Other overheads, 60 million. All sales are VAT exclusive. If they say VAT exclusive, VAT is not there. So we shall be determining VAT at 18%. The purchases and expenses are VAT inclusive. VAT is in there. So we shall use 18% over 118. Why? Because value added tax is added to the value of the transaction. The tax is added to the value of the transaction. So I will say value added tax. Add the tax on the value. So your 100%, your sale, you take your sale 100%, but then we add this tax. The value is added on top of the tax is added on top of the value at 18%. So that's where I'm getting the 118. So for inclusive, shall be using 18 out of 118. Okay, so we continue to look at the required. What are we required to do? Number one, we are required to advise if this man should register for VAT. Okay, that's number one. Then advise him on the VAT implications of his transactions for the month of March 2025, clearly explaining to him why he should have used some of the information and left out some. To advise him on the VAT payable and claimable by him. Okay, good. So this is an exam type question. Very, very good question if you really want to understand the treatment of VAT. My assumption is that you've read through. This very question can still be downloaded from your student account from the WhatsApp group. You can still download the question. So I'm going to take you through. I'll assume you don't know how to do it. So I'll be doing it and guiding you. Then I'll give you a task for you to do. Okay. So what are we going to do? We are going to prepare the return. I always want to bring in a practical aspect. So when we are preparing the return, what do we need? We need, let me see, 1, 2 schedules. Schedule number one. Schedule number 1, you need to furnish information regarding the transactions with your customers. Transactions with your customers. Those are the sales. If you're VAT registered, we mentioned that if you're VAT registered, you need to charge VAT on your transactions. Transactions with your customers. You need to issue an e-invoice. E-invoice. That invoice should show the VAT applicable. But of course, the rates are different. We have seen that some transactions are 0 rated, others are standard rated. There are also transactions which are totally exempt as per schedule number 3, third schedule. 0 rated is schedule number 4. If you're reading from the new tax law. From the old tax law, exempt is the second schedule, and then 0 rated was the third schedule. Okay. So what are we seeing here with KAZINDA? He has a transaction, general merchandise, a sale to the tune of 35 million. Fish, sale, tune of 40 million. Cows, a sale, tune of 50 million. General merchandise, 150 million. He then exports fish to Rwanda, 300 million. A total supplies of 575 million. Now, general merchandise is absolutely standard rated. Sale of fish is exempt. Cows, exempt. General merchandise, 18%. General merchandise, I'm talking about things like stationery, mineral water, basically where there is VAT. Exports, 0 rated. We gave a reason why exports are 0 rated. Because if you charge VAT, you're making them expensive. So that's why it is 0 rate. If I press my calculator, on the general merchandise, 18% of 35 million gives me 63 million, standard rated. When it comes to sale of fish, if I bring in, okay, there's nothing here, 0, nothing. Exempt supply. Sale of cows, nothing, exempt. General merchandise, again, I use my calculator, 18% on 150. That gives me a figure of 27 million, standard rated. Exports, 0 on 0. 0 on 300 million. That gives me 0, and that is 0 rated. So we have a total output tax of 33.3 million. But now we need to answer question number 1. Should KAZINDA register? Should KAZINDA register? Now, we cannot just look at the 575 because we have exempt supplies. The VAT law requires that we determine the percentage of the taxable. If the percentage of the taxable supplies exceeds C, if the percentage of the taxable supplies exceeds Z, how much in the chart? What's the percentage? If it exceeds Z, the percentage of the general merchandise exports, if it exceeds Z, 5%. If it exceeds 5%, we register. Okay, 5%. 5%. Now, I want you to sit on your calculator right there where you are. Give me the percentage of taxable supplies. Let me first cover the exempt. What is the percentage of the taxable supplies. I want us to go bit by bit, okay? Bit by bit, step by step. Let us not panic. Slowly, move slowly, bit by bit. We need to bring out the concept, the issues clearly. So I need from you, everybody, if you don't give me, I'm going to log you out because this is a bonus lecture anyway. I'll log you out. If you don't give me the percentage, I'm going to log your device out. So you have 5 minutes. Give me the percentage. 5 minutes. Let me pause a bit. We are saying that his taxable supplies are more than 5% of the total supplies. If, it could have been more than 150 million, but the percentage knocks him out because of the fact that he has exempt supplies within his total supplies. In the total supply of 575, he has exempt supplies. He has exempt supplies in there. So before you even conclude, yes, it is true, his taxable supplies are 485, which is more than 150. But the issue is, are they more than 5% in the mixed supply? It can be 485, but it is less than 5%. Still, he cannot register because his exempt supplies will be more than the taxable supplies. So that issue you need to note. Do not only look at the 485. Is the 485 representative of a percentage more than 5%? If the answer is yes, then he's supposed to register. Now, KAZINDA is still in trouble because of the exempt supplies. Being a dealer in both taxable and exempt supplies, KAZINDA cannot claim all the input tax since his exempt supplies exceed 5% of the total supplies, exclusive of VAT. The business is regarded to be dealing in mixed supplies. The business is regarded to be dealing in mixed supplies. Now, there is an issue I've brought up right now. The issue of input. So input is in our schedule number 2. That is the tax on purchases. Whereas KAZINDA is charging his customers VAT, the output tax, his suppliers are also charging him VAT. So he spends on VAT as well, but also generates VAT. I should put it that way. He generates VAT, but also spends on VAT. So the tax law allows you to offset your generated VAT vis-a-vis the expenditure on VAT, the offset. It allows you to offset the input against the output. But his disadvantage is that he cannot claim 100%. He can only claim up to the tune of 84.35% of his input. You are given input deduction or credit to match or in proportion to your taxable supplies. Basically, what the government is saying here is that deal more in taxable, because that's where we also benefit as government. Because if you deal in exempt, we don't benefit. There's no tax there for us to collect. But with the taxable, there is tax there for us to collect. So we shall give you up to the tune of 84.35 because you have also punished us by including 15.6%. We did not collect tax. We cannot collect tax there. We only collected on 84.35. So we are giving you offset of 84.35. So I hope you've understood all those issues there. Now I'm going to bring in more advanced VAT. Okay. I'm now going to take you a notch higher. I'm going to stretch you a little bit. Let me stretch you right now. Assuming it was the other way around. Assuming it was the other way around. Where exempt. Where exempt. Let me just change it a bit. Let me say percentage of taxable. Let me change it. Percentage of taxable. Percentage of exempt. I want you to pay much attention here. Okay? Much attention. Much attention. You may not find this one in your office. It may not be there. When you're filing those returns at your tax agency, you may not find this. You're going to find it here. Assuming it was the other way around. Where? Let me put this one in a different color. Blue, red. This one red. Where the exempt supplies are more than the taxable supplies. Assuming this was the case, would this be good or bad for KAZINDA? Share with me in the chat. Would that situation be good or bad for KAZINDA? Share with me in the chat. Is that good or bad? Is that good or bad? That is bad. Good. That is bad for KAZINDA. That is bad for KAZINDA. You don't want to be in that situation. That is bad for KAZINDA. Now, thank God you have seen that it is bad. Now, in our language of taxation, we shall say, in our language of taxation, we shall say KAZINDA is disadvantaged. Okay? In our language of taxation, if the percentage of the taxable supplies is less than the percentage of exempt supplies, we shall say KAZINDA is disadvantaged. We shall say KAZINDA is disadvantaged. So you as a tax agent, if you detect that, you should quickly inform the Commissioner General. You should quickly inform the Commissioner General that we need to use the standard alternative method. Don't use the general apportionment method because you are disadvantaged. What I said that we are giving you an offset of only 84% is what we call the general apportionment method, the default method. By default, we are supposed to use the general apportionment method where you only claim input to the tune of your taxable supplies. And in the case of KAZINDA, he can only claim 84. 0.35%, which is okay if that is the situation. But if the situation reverses itself and you find that the exempt supplies are the ones which are more, then rush and use the standard alternative method. Let us go through this one quickly and fast. Standard alternative method. That is what is on your screen. Let us read through. Persons, taxable persons disadvantaged by the general apportionment method may apply to the Commissioner General to use the standard alternative method, SAM, which when granted permits the taxpayer to directly attribute input tax separately to taxable and non-taxable supplies, insofar as it is possible, and claim credit accordingly. I will explain that. Therefore, when using this method, the taxpayer will claim all the input tax paid on the taxable supplies, including expenses incurred on the inputs related to taxable supplies. No input will be made on expenses incurred on inputs that are related to exempt supplies. So here what we are saying that the standard alternative method gives you the opportunity to claim 100% of your input on taxable supplies. And then you don't claim anything on exempt supplies, which is better because you're disadvantaged. Your percentage of taxable is lower than the percentage of exempt. Apportionment will be made for the input tax that can't be attributed to any particular type of supply. These will usually fall under overheads. The use of the sum is applicable from the time the applicant taxpayer becomes disadvantaged. Did you hear that? The use of this method is applicable from the time. That's why I'm saying that the minute you detect that your client Kazinda is disadvantaged, you apply that you want to use. But even when you're registering for VAT, remember I showed you the registration process. You asked, do you want to use the standard alternative method? You can only answer that after assessing your percentage of exempt and standard rated. This rule was held in the case of URA versus Shoprite Checkers Uganda Limited. You will check out that ruling. You will check out that ruling. The judge said that the minute you feel disadvantaged, run to URA, ask to use this standard alternative method. Now, this standard alternative method is not approved under normal or all circumstances. You are only going to get the approval if you're disadvantaged. The Act also guards against manipulation of the apportionment fraction, since the formula is based on the data for each tax period rather than the financial year. Accordingly, where the taxable person claims input tax credit on account of making mixed supplies in any tax period, the taxpayer is required to make a calculation based on the annual value of the taxable and exempt supplies. This is to ensure that the tax paid or credit claimed of a period of 1 year does not exceed what is properly payable by virtue of using the apportionment formula. Have you heard that? So I'm going to share this piece here, standard alternative. So we are not going to use, because some people may ask me, why don't we use the standard alternative method? No, we are not going to use it. Why? Because Kazinda, our Kazinda here, is not disadvantaged. He is not going to get the proper approval. Though if he uses the standard alternative method, he's going to be at a much more advantage. He's going to save more money. So we continue by saying that Kazinda should opt for the general apportionment method of determining the VAT claimable, since the percentage of the taxable supplies exceed that of exempt supplies. So he has to use that. So I hope you've taken note of all those points there. So we are done with schedule number 1. Now we are going to go to schedule number 2. In schedule number 2, we have the purchases and expenses. I'll read this out because I know you have already read through the question and you know. The first one is the import. KAZINDA imported goods from Japan. CIF value was given. We managed to calculate the taxable value, which we charge at 18%, and this gives us VAT of 13.6. I'm going to show you my working number 1 later. Number 2, we have transportation of goods. KAZINDA spent 10 million to transport the goods. That is 0%. So that is a zero rated supply. Local purchases to the tune of 70 million. VAT is inclusive, so we use 18 out of 118. I explained that. The VAT is 10.6, standard rated. He spent on salaries and wages to the tune of 15 million. Salaries and wages are outside the scope of VAT. He spent on repairs and maintenance to the tune of 5 million. Here we mentioned in the discussion that you cannot claim VAT on repairs and maintenance unless you are in the business of hiring automobiles. Telephone bills, he spent 1.2. And here we are saying that you will only claim 90%. So that is VAT inclusive and claimable. You can claim on that. Medical bills to the tune of 2.2, exempt, exempt supply. Office stationery to the tune of 1.3 million, standard rated, claimable, VAT inclusive, 18 out of 118. Water and electricity for the month of March, 450, VAT inclusive, 0 because the tax point is in March. Right now we are doing for April. Oh, right. The tax point is March and not April. Okay. We are doing for the month of, let me see, let me check. I think I don't change something here. During the Feb. Okay, this was supposed to be Feb. Yeah. Tax point. This is water and electricity for the month of February. You won't get, because the tax point, you are supposed to file the return and include this in February, not March. I mixed up the months there. Then the water and electricity for the month of March. That is the 550. This must appear in today's return. That is 83,898. Input is accounted for now and claimable. Okay. Input is accounted for now and easy. Just a minute. Claimable. I need to share something here. I need to share something here. Okay. Just a minute. Just a minute. Electricity for the month of April. This one you can claim because the tax point is now, because you've decided to pay now, so you account for the VAT now. Tax point is the date of payment. Return of goods. Here you need to raise a credit note. You reverse this through a credit note. The input tax that had been claimed earlier has to be reversed through a credit note. You can do that in IFRS quickly and easily. Bad debt written off of 25 million, 18 out of 118. That is 3.8. Output tax accountable on the bad debt is claimable. Overheads, 600 million, VAT inclusive, 9.1 million, standard rated. So that gives us total input of 36. You add through. I'm going to share this entire solution. I'll begin by first of all showing you my working one, where we worked out the taxable value of the goods that were imported. So the CIF value is 55 million. We charge import duty at 25%, and that gives us total A, which is CIF and import duty. Then excise duty is on the 68.7 million, which is 10%, giving us total B. And that's the taxable value on which we charge VAT at 18%. So that's the 75,625. Then, of course, the last schedule, we now determine whether KAZINDA has claimable payable position. So we shall get the total output from schedule number 1, 33.3 million. Then we less the input to be offset. Remember, I mentioned that KAZINDA is going to be given an offset to the tune of 84.35%. So on the 36 that we have here, but I have to remove the bad debts because these bad debts was part of output sometime back, so you cannot apportion it. So I get 84.35%. Then I'll claim the bad debt separately without offsetting it. This one I have to claim all of it because the guy didn't pay, and this is VAT we paid on the bad debt. So apportioning it to 84 is not reasonable and incorrect. So that's why I have to subtract it, and then I charge 34.35% to get the input tax to be offset. So the VAT payable to URA by KAZINDA comes to 1.78292, and you write a check to URA of that much. So that is the story of KAZINDA and his tax liability.